Hey everybody, it's Larry Berman here, and boy, another interesting week in financial markets. Let's have a look at what's on my radar and dive right into the chart room. We often start with a look at the economic calendar and see what new information we learned this week. At the end of the week, we got data from the S&P Global Manufacturing and Services surveys. So, there's the ISM numbers, which is the National Association of Purchasing Managers, formerly now called the Institute of Supply Management, that does surveys. This is a slightly different survey. Doesn't cover exactly the same industries. There's a lot of overlap, of course, but in essence, manufacturing and services. And you can clearly see the recession. So a number below 50 means contraction, above 50 means expansion. You can clearly see overall we're in expansion. Remember, 70% of the US economy is services, so more heavily weighted towards services in terms of the total number. But as you can clearly see, while we're still in expansionary mode and the economy is growing, the manufacturing side is in recession. One of the key catalysts that's keeping the economy expanding at a nominal clip anyways is the fact that people are still working. We have not seen a significant decline in the employment situation. However, in the initial claims data this week, we got another uptick in the number, which was a slight upward revision from last month. And so when we look at this on a graphical basis, you'd say, Larry, it will kind of make heads or tails of that chart. This is the last 10 years of initial claims. Well, obviously the shock of COVID skewed the data significantly. Let's zoom in on the pre-COVID period, and then we'll look at more normalized numbers recently. So coming out of the great financial crisis, slowly, economy's improving, and you get down to a level of initial claims in the 200 to 250 range, really low 200s, 200 to 230, and that really is full employment, economy's firing on all cylinders, and pretty much everything's good. You'll all recall this is when the Fed started to hike interest rates and shrink the balance sheet. We'll take more of a look at that in a few minutes here. And so when we look at that perspective, you say, okay, well, let's look at what's happening, say, in the last 2 years since we've normalized from COVID and they stopped, the lockdowns. So you have the last 2 years, basically, you have us normalizing in the low 200s. And now we're starting to see both on the 52-week, these are weekly numbers, 52-week now starting to turn up, and the 3-month has been turning up for a number of weeks now. Normally you would look at a 1-month average too, and of course the 1-month average is now up here. So you've got the momentum shifting towards higher weekly jobless claims, which means the labor market is softening. And it's softening past the point where you would consider things really firing on all cylinders. So good news in that the Fed wants to see some of this, but bad news is that you're going to start to see more of the mom and pop get affected. So when Standard & Poor's Global came out with their report this morning, they comment on the fact that it's the services side that's keeping things going. The manufacturing side in many pockets of the economy is already in recession. So when we look at that ISM historical number, we can't look at the S&P Global. The data doesn't go back, but the old National Association of Purchasing Managers Index, now called ISM, Institute for Supply Management, back to the 1980s, overlaid with all the recessions. And so you can see here that when this turns down below 50, you don't always automatically get a recession. There was a pocket here in 2012, part of the second phase of the European debt crisis. You had the pocket of weakness here. This was oil prices starting to come down, pretty significantly with the fracking boom that started in 2013-14, really put some pressure on the manufacturing output side. So then looking at the other periods here, mid-1990s, we saw a move by the Fed to raise interest rates, and you had a shock there. There was no actual recession. In 1987, with the stock market crash, there was no actual recession. In this period where manufacturing started to turn down, the recession came, of course, in the early 1990s, coinciding with the first Gulf War. Then you had the dot-com bubble burst in here, and 9/11, obviously the great financial crisis, and COVID. Very brief recession because they just threw all the money in the world at it. Now we're kind of thinking more this way with sticky inflation, and not kind of the double digits that we had there, but this kind of economic behavior in the next couple of years. And so we're not going to likely get the Fed easing this time around until inflation comes down. So if you look at the Fed's message, they've basically managed to take out the rate cuts from 23. So, good job there, Powell and co. But now the market believes going into 2024, not unlike the Fed forecast, that we're going to see another rate hike, at least one, that's priced in basically by November, and 6 rate cuts, so one more hike, 6 cuts into the end of 2024. So that's kind of what's in the money market right now. And will that actually happen, or will they keep higher for longer message going and going? Well, the telltale of that will be, what happens in the employment market? Do we get a hard landing for the economy? If we do get a hard landing, forcing them to ease, this is not a buy risk on for the equity markets. This is earnings are going to get hit really hard. And so, we're going to get some multiple contraction, risk premiums are going to go up. That is not in the tape whatsoever. So when we look at the S&P 500 here and we get a sense of the last year and what's going on, clearly the market's breaking out on expectations for Goldilocks, perfect soft landing. The inflation numbers are coming down. The Fed is mentioning it. They're happy. Risk on, buy long duration assets, and the Qs and friends are leading. We've got a bit of a broadening in the rally, which kind of ended in the last week or so. And now we're in the correction phase. So how does this correction play out? Hard landing probably takes us back towards the 2022 lows, but maybe not that bad. It really depends on earnings, and we're just not going to have a sense of that. We'll start to hear from companies. FedEx didn't have good news. When you start to hear from some of the consumer cyclicals, they're saying consumers hanging in, which makes me revert back to the employment situation and job losses. Those are starting to tick up. Slow moving, glacier pace, months and months and months and months and months. So this isn't going to play out for the next 6 to 12 months in terms of how hard the landing is. But eventually the markets are just going to have this aha moment. So where are we going to correct to between now and the seasonally weak period in October? My guess is somewhere in this retracement band from the March low. That would take us somewhere between 4050 on the S&P to 4200. Your guess is as good as mine at this point. I would say the best support is towards the lower end of that range, where we saw resistance initially trying to break through. We should see good buying and support come covering and that kind of thing for people like us and others who want to buy the dip. That should hold initially. But if the job loss is more acute and dramatic and earnings get hit, these levels aren't going to hold. And we look at 3,800, into end of the year or into the first half of 2024. If we look at the Fed balance sheet and liquidity, we're now pretty much back. We had this bump in the Fed balance sheet. It was thought to be a liquidity injection by all these programs they put in place to support the banks. We've been told repeatedly by really smart people this is not liquidity. We're now back to the point where the Fed is going to unwind this. Here's the US election. They would like to get the balance sheet down towards 7 trillion by that point. That's another 1.4 trillion of supply in addition to the 1.4 trillion annualized of deficits we're going to see between now and then. And so a lot of weight and liquidity sucking out of the capital markets to feed that hungry bear called the U.S. government deficit. And that, when you look at the Congressional Budget Office forecast out a decade, 32 trillion of debt today is going to go to 50 trillion of debt. And to me, there's no chance we're ever going to get out of this debt monetization. So, story for another day. Liquidity suck out into early 2024. They still haven't really reduced mortgage securities yet. So it's going to be very interesting how this affects risk premiums. Can't be positive here. The idea of a perfect landing to me is a bit naive. So when it comes down to the bull and bear pick of the week, what do you do on the bullish side here? In recent weeks, we talked about some energy trades. Those have been good bounce trades, but really, if we're going into a harder economic landing, it seems clear from the false start nature of the energy sector here that it can't catch on. And the fact that it can't catch on here and really run with XLE getting back above 90 tells me we've got to visit the low 70s or even the high 60s first in the energy names before we can go higher. So I still like that as a buy dip story. Precious metals here, GDX below 30 starts to get interesting. I love it at 26. I like it a lot at 28. 30 starts to get interesting. We were sellers into 34 and 35 months ago. Gold is a trade for us, same as silver. So those now come back on our radar. I love clean energy here. Looks very, very interesting to me. There's a lot of thematics. Cloud, AI, all that, very overbought. We sold a bunch of cloud last week at the options expiry, writing puts to buy it back on a dip. So still like them structurally, but tactically, reduce some exposure there and, looking to buy the dips. Overall message still, folks, very, very cautious. Have a great week, everyone.